Good day, Sir Alvin, Lentejas, and classmates. We are Group 5 and today we'll discuss 4 topics. First is we have the financial planning process to learn about setting goals and managing money. Second is we have debt capital versus equity capital, where we compare borrowing funds and getting investors. We'll also explain sources of short-term financing for quick needs and lastly, sources of long-term finances for future growth. So let's get started.
Good day everyone, my name is Sheryl Mae J. Caibog. I'm going to report the financial planning process. So first, it's easier to spend than to save. We all know na mas madali ang paggastos kaysa sa pagtirok. Why? For example, may nakita na usa na bagay na maupay or may nakita usa na tao na bagan nakatan to siya na hala bagan kaupay sini na nagamit sa iya or bagan naangay sa iya. Ban karoy mulat paliton iton basi umangay lat sa imo basi maging maupay lat ang pagkita sa imo sang tao gan. Instead na an kwarta unta na igpapalit mo isterokon mo nala bagan ginpapalit mo nala or gingastos mo sa wara la kabuluhan ganon. Mas makurian pagtiro kaysa sa paggastos. Second is personal financial planning is an ongoing process. It changes as your financial situation and position in life change. So, importante na may dakit financial planning. Kay pagwara kat nga ni financial planning ko, wari ba mahingad tuan na naton kwarta. For example, kung wari ka financial planning is kung nanuli mo mapinsaran na paliton or kung nanuli mo mapinsaran na paggastusan sa nimo kwarta is diretso la bagan pag naubos siya bagan kairo mo naliwat kay syempre waray ka naman kwarta. Alay kung may financial planning ka, maaram ka kung diin mo iton i-spend, maaram ka kung para sa nano iton, like that. The third one is manage and control your finances with a personal financial plan. Yan kung ani kanina, importante ang financial planning. Sa dili naman sa third bullet is kinahanglan naton i-manage nga i-control ang naton finances. For example, kung wala man kabuluhan ng mga bagay ba or kinahanglan ta mahibaruan ang needs nga wants. Pag needs nga ni maramang kam sa needs, diba? Ang need like kung ano talaga imo kinahanglan sa panadlaw-adlaw while unwants naman is karoy mula ito na bagay pero pag nagamitan mo na or bagan nagsawa ka na is bagan useless ito na bagay kaya syempre di mo gagamiton kaya nagsawa ka na ganun bagan na relationship wala char. So next is importance of personal financial planning. First is accumulate wealth for special expenses. So inian pagtirok kwarta or assets para sa mga espesyal na gastusin sa paglipas ng panahon para matugunan ang mga particular na pangailangang pinansyal. The second one is save for retirement. Igsiset aside mo anin kwarta habang nagtatrabaho ka sa sulod sa usa ka bulan para may daka fund pag undang mo pagtrabaho. Like dire porket may daka kwarta is gastuson mo la san gastuson na kay once na pag naubos na kasi ang kwarta wala ka na pagkukuhaan pa. The third one is cover your assets. Inian pag-protect san kung nanon may daka na may value pares na nalakon may savings ka, investments, properties. So damo strategies para sigurado na diri karag an imo gintrabahuan inkurian kay at the end of the day magamit mo ito na imo gintirok sa oras san imo kinahanglan. Fourth is invest intelligently. So, dapat madiskarte kit sa aton mga decision kapag nag-invest kit or investan usa na kwarta. Dapat may ngadto siya sa maupay ngan garantisado na waray ka kalugian. For example lala pag halimbawa may daka budget or lote or tuna ba tas Kay at the end of the day kasi sa antuna is pag halimbawa paglipas ng panahon, antuna is nagdadako ang iya rate. Tapos alahas pag pero sana 5 or 10 years from now, ang alahas is nagdadako ya value. That's why pag nag-invest ka sana ng mga butang or mga bagay is diri ka lugi pag ulpot sa panahon. Next is 5 basic steps to personal financial planning. The first step is evaluate your financial health. Inian pagsurion mo ang imo current financial situation para mabaruan mo kung paano ka kaupay mag-manage san kwarta nga di mo mabaruan kung di nalandas mo ba maabotin mo goals sa pananalapin the future. So, evaluate your financial health is made siya 4 categories. The first one is calculate your net worth. The second is examine your cash flow. When we say examine your cash flow, inian pagsubaybay mo sa imo income tas mga nagastos para ma-identify kung di ini ngadton imo kwarta. The third category is assess your debt. When we say assess your debt, inian pag-calculate sa imo inutang. If mababa ang kantidad sa imo utang, it means ipapalagan mo na mabayaran imo utang. Pagataas nga ng kantidad sa imo utang, it means na pasanin siya sa imo na kinahanglan mo na undangan ng pag-inutang. The fourth category is evaluate your emergency fund. When you say evaluate your emergency fund, may dapat emergency fund para sa mga di inaasahang pangyayari like pag nawadan ka trabaho or pan-medical na emergency. Second basic steps to personal financial planning is define your financial goals. When we say define your financial goals is ini ang pagtukoy sa imo goals or layunin para sa imo karuyag makamit sa pananalapi. Bagan maghimo ka roadmap para sa pag-manage sa imo kwarta, whether igtirok mo iton, igpuhunan sa business or maghimo mga plano na ayon sa imo mga priorities. The third is develop a plan of action. Ini ang paghimo specific nga step by step na strategy para maisa katuparan ang imo goals. Para sa lasan paghimo outlines ang imo himo na action para makita mo imo progress. Kaya ang open na plano is ini-organize ka para maabot ang imo goals. Next is implement your plan. Ini ang stage na igsasakatuparan mo ng mga steps sa imo plano. Pero ang pagkatuparan sa usa na plano na kailangan sa disiplina, pagkakapareho ngan pagsunod. Next is review your progress. Ini ang part na surion kung may progress ka ba. Kay kung may progress ka, igpadayon mo lang imo plano ng strategy. Pero kung wala ka nakita na progress, ini ang time na i-revise mo imo plano or strategy.
Hi everyone, I am Bea Francisco from BSIS. My topic is all about financial planning process. The financial planning process, a systematic approach to managing one's finances. Like for example, you're gonna set up goals, managing budget, investing your money. There's also establishing your financial goals. There's how the short term, intermediate term, and the long term. Next is the short-term goals. The short-term goals are defined as accomplishments that take 3 months to up to years. Like for example, pay off loans and credit cards, purchase a major item, finance a vacation. Next is the intermediate term goals. These are goals that can accomplish in 1 to 5 years. Like for example, save for older child's college, save for a down payment, pay off major debt, finance large item or weddings, purchase a vacation. Long-term goals save for younger child's college or objectives you want to achieve months or year down the road. Like for example, purchase retirement home, create retirement fund to maintain current standard of living, take care of elderly family members, start a business. Being successful in your career. Do a good work project, the right image, understand and work within the power structure, gain visibility. Principle 1. The best protection is knowledge. Understand the basic of personal finance. Take responsibility for your lifetime financial plan. Seek professional advice wisely. Principle 2. Nothing happens without a plan. Easier to think about spending than about saving. Saving must be planned. Putting up a financial plan means goals are harder to achieve. Principle number 3. The time value of money. Money received today is worth more than money received in the future. Understand how savings and investment grow over time. Understand compound interest. Understand spending now and paying later. Principle number 4. Taxes affect personal finance decision. Know the effect of taxes on the rate of return of investment. Compare investment alternatives on the after-tax basis. Understand tax. Principle number 5. Stuff happens or the importance of liquidity. Plan for unexpected events. Have money or liquid funds. Available liquid funds should be covered to 3 months of living expenses. Principle number 6. Waste not, want not, smart spending matters. Differentiate want from need. Do homework before the purchase. Make the purchase at the best price. Maintain your purchase.
So good day everyone, I'm Sheryl Solano and my topic is all about dev capital kung sa aton pa term is inutang lang na kapital. So dev capital refers to funds borrowed by a company that must be repaid over time, typically with interest. It represents a liability on the company's balance sheet. Common forms of dev capital include loans, bonds, and debentures. So when we say dev capital, it is the money that is borrowed and must eventually be repaid, usually with interest. Like for example, familiar man diba sa mga lendings, inisira, pag umungay or magpa-member ka nga ni sa IRA, kinahanglan mo anay sumunod sa IRA mga rules and regulations. Maghatagasan imo personal informations, financial stability, sira sino ang pwede mo ma-beneficiary ngan kung nano ang gamit na may daka sa iyo balay na may value. Pares na lasan, refrigerator, TV, and etc. Sa lesson 4, mapapakita ang liabilities or pananagutan mo pag naging member ka na sa IRA. Ngan pag tumugot ka, mao ka interviewon kung dapat ka ba pautangon. So later on, mabaruan ta kung nano-nano baan mga liabilities kung mangutang kit. So common forms of debt capital include loans, bonds, and debentures. So here's the example of loans. So loan is a financial arrangement where a lender provides money to a borrower with a repayment schedule, interest rate, and terms agreed in advance. Loans are used to finance major expenses or investment and play a crucial role in personal, financial, and economy by enabling growth, investment, and financial goal realization. So, ali din nakikita ang mga expenses nimo. Like for example, ala didi sa ton kuan, sa example didi sa screen. So, makikita nimo kung pera pan balance nimo ang total interest, tas ang payment na imo kinanglan bayaran, principal, and the payment date kung sano ka nagbayad. So this is the example of bonds. So bonds are debt securities issued by governments, municipalities, or corporations to raise capital. Purchase bondholders lend money to the issuer, who repays the principal on the set maturity date. Bonds are safer investments than stocks but carry lower returns and risk. So, based on this example, for example, Treasury bond issued by the Bureau of Treasury. So, ibig sabihin, nagpapautang ang gobyerno ng Pilipinas. So, for example, an issue date niya is January 1, 2022 at ang amount or ang principal value 100,000 pesos. Ang principal or ang amount ay tinatawag ding par value. Same la po iton kung may nabatian kam na par value, ito na po an itatawag na principal value. Ito na inpapahuram niyo sa bond issuer. In this case, ang bond issuer ay ang gobyerno ng Pilipinas sa pamamagitan ng Bureau of Treasury na ang tawag ay Treasury bond. So, gaano katagal ang Treasury bond na ito? For example, ito ay 3 years bond. So, ibig sabihin, kung ang bond is issued by 1st of January 2022, magmamature ito ng 31 of December 2024. Ngayon, magkano naman ang interest ng bond na ito? For example, ang interest bond is 5% per annum Gaano naman kadalas ang interest payment? So, pagpalagay na lang natin is semi-annually, ibig sabihin 2 beses magbibigay ng interest payments ang band na ito every June and December, twice a year ngayon. Paano kikita ang band na ito? So, based of this example na naka-indicate sa table on year 1, year 2, and year 3, sa year 1, June and December 2022, ay magbibigay ng interest payment ang ating band, kaya on June 2022 ay may 2,500 at sa December 2022 ay 2,500. Ang 2,500 ay galing po yan sa principal amount or the par value of the bond, which is 100,000 pesos multiplied by 5% kasi yan po ang interest niya sa isang taon, kaya ang interest niya sa isang taon ay 5,000 pesos. Dahil 2 beses ibibigay sa iyo ang interest payment na ito, i-divide lang po natin yun ng 2 beses. Isang 2,500 ibibigay sa June at yung susunod na 2,500 ay ibibigay naman sa December. Kaya 5,000 or 5,000 pesos, or that's 5% of the 100,000 pesos ang interest ng bond. On year 2, same lang din, June 2023, 2,500 and December 2023, 2,500. Total, 5,000 pesos on the second year, 2023. And lastly, June 2024, 2,500 pesos and December 2024. So ito po, dito na po magmamature ang ating bond, kaya 2,500 yun po yung last interest payment, and ibabalik sa iyo ng bond issuer ang 100,000 pesos. Kaya on December 2024, makukuha mo lahat ay 100,000 to 500 pesos. Yan po ay galing sa interest payment ng 2,500, yung last interest payment plus yung principal or par value ng 100,000 pesos. Finally, debentures. So, here's the example of debentures. A debenture is a long-term debt instrument used by companies to borrow money from investors. Typically unsecured and based on the company's reputation and creditworthiness, they are often issued for large projects, expansions, or other financial needs, offering higher interest rates to attract investors. So, advantages of debt capital. First one is the flexibility. So, flexibility is debt instruments can be structured in different ways to fit the borrowing company's needs, including the amount borrowed, the duration of the loan, the interest rate, and the repayment schedule. So, debt instruments like loans and bonds offer significant flexibility in their structure, which allows companies to tailor them to their specific needs. Companies can adjust various factors such as the amount borrowed, which can be scaled up or down depending on the project or purpose. The loan's duration, interest rate, and the repayment schedule can also be customized, making it easier for companies to align their payments with their cash flow and long-term financial strategies. Second, predictability. So, predictability debt agreements typically include fixed repayment schedules, which can help financial planning and cash flow management. New companies are even making it possible to view and analyze credit spreads within private credit. So, predictability in debt capital. Debt capital agreements provide predictability as they usually come with fixed repayment schedules. This consistency helps businesses plan financially and manage cash flow more effectively by knowing exactly when payments are due and in what amounts. Additionally, innovation now allows companies to view and analyze credit spreads within private credit, offering insights into borrowing costs and market perceptions of risk, which can further aid in financial planning and decision making. Lastly, speed. So, issuing debt can often be quicker than equity, especially for facilities like lines of credit or short-term commercial paper. So, debt issuance can be faster than raising equity because it involves fewer regulatory requirements and approvals. For example, obtaining lines of credit or issuing short-term commercial paper typically requires less time than going through the extensive process of issuing new shares. This speed allows companies to access needed funds quickly, which is particularly useful for addressing short-term financial needs or taking advantage of immediate business opportunities.
Good day everyone, especially to you, Sir Alvin. My name is Margaux S. Isanan. I am a student from BSIS 2B, and today I will discussing all about equity capital. Equity capital represent funds raised by issuing shares of the company, giving investor ownership stakes. It does not require repayment but entitles investors to a share of the company's profit and voting rights. Equity capital appears as a shareholder's equity on the balance sheet. Para mas maintindihan ta, for example, ang kumpanya nagbabaligya sa mga parte sa iya kalugaringon o mga shares ngadto sa mga investor nga nagiging bahin nga tag-iya. Diri na kinahanglan nga bayaran sira pero makakarawat sira sin bahin sa tubo sa kumpanya ngan may ada sira karapatan sa pagbuto sa mga desisyon sa kumpanya. Makikita ang pagmamayari sini nga balance sheet sa kumpanya bilang shareholders equity. Next are the advantages of equity capital. First is no repayment obligation. Unlike debt financing, equity capital does not need to be repaid. For example, may dako sa nga friend nagparam sa akong kwarta para makapalit ak new phone. Kung sa utang pa ini, kinahanglan mo sira baydan sa bugos na kantidad nga plus sa interest pa. Pero kung mag-invest sira sa imo negosyo sa phone, pareha sa pagpalit sa mga shares sa imo kumpanya, diri mo na kinahanglan baydan pa sira. Naging bahin na sira nga tag-iyangan, nakarawat sin bahin imbis sa imo tubo. Second is no interest. Equity financing does not involve interest payment. For example, magporam ka sin kwarta sa bangko para sa auto. Kinahanglan mo nga bayaran ang kantidad sa utang dugang sa interest. Pero kung ibaligya mo ang bahin sa imo negosyo sa auto, ngadto sa usa nga investor, diri sira makarawat sin mga bayad sa interest. Naging bahin na sira nga tag-iya nga nagbahin sa tubo, naging himo sa imo negosyo sa auto. Third is access to additional resources. Investors often bring more than just capital. They can offer valuable resources such as expertise, industry contacts, and strategic guidance. For example, imagine gumamit ka sa Weather app ngan Caoyong mo maadman ang forecast para sa sunod nga semana. Ini nga app kaya ma-access ang mga additional resources, for example, ang Weather API, para matagan ka sa tabang nga data sa Weather. That's all. Thank you.
Good day everyone, especially to you, Sir Alvin. My name is Recil D Caoyong from BSIS 2B student. Today, I will be explaining about the 5 similarities of debt and equity capital. First is funding purpose. Both types of capital are used to fund business operation, expansion, and growth. Ang funding purpose, ito ay tumutukoy sa kung paano ginagamit ang pera na nakukuha ng isang negosyo. Ngan may duwa siya na uri isang capital sa funding purpose, which is undip financing and equity financing, which means undip financing is pag-utang ng pera mula sa mga bangko o namumuhunan. Tapos ang equity financing is pagbibenta ng bahagi ng negosyo sa mga namumuhunan. Second is investment in the company. Both debt and equity investors provide capital to the company with the expectation of a return on their investment. Ang investment in a company ay pagbibigay ng kapital o pera sa isang kumpanya na may inaasahang return on investment o kita. Ngayon may duwa na uri ang may namumuhunan, which is a debt investor and equity investor, which means debt investors maunin siya ang naghahatag utang sa usa na kumpanya. Ang ira return on investment o kita ay ang interest na ira makukuha sa usang negosyo. Tapos ang equity investor is siya ang bumibili ng bahagi ng kumpanya. Ngayon ang ira return on investment o kita ay ang pagtaas ng halaga ng kanilang mga share o bahagi ng kita na kanilang matatanggap sa usang negosyo. Third is impact on financial strategy. Both influence the company's financial strategy, affecting decisions related to leverage, risk management, and capital structure. Ito ay parehong nakakapekto sa debt at equity ng isang kumpanya sa pamamagitan ng impluwensya sa leverage o pagkakaroon ng utang, which means ito ay kailangang magpasya kung gaano karami ang utang na dapat gamitin upang mapalaki ang kita. Tapos, ang risk management Sa epekto sa financial strategy, ito ay tumutulong sa pamamahala ng panganib na maaring makaepekto sa kita o operasyon. Tapos, ang capital structure naman, ito ay tumutukoy sa halo ng utang at equity na ginagamit ng kumpanya upang punduhan ang mga operasyon nito. Potential for return. Both can offer returns to the investor, debt through interest payments, equity through dividends, and capital gains. Ang potential for return ay parehong may potensyal na magbigay ng kita sa mga namumuhunan. Ang debt ay nagbibigay ng interest habang ang equity naman ay nagbibigay ng dividendo at capital gains. Last is influence on company valuation. Both can affect the company's valuation and financial health. Debt impacts the company's leverage, while equity influences ownership, structure, and control. Ang influence on company valuation, ito ay parehong nakakaapekto ang debt at equity sa halaga at kalusugan ng pananalapi ng isang kumpanya. Ang debt ay nakakaepekto sa leverage, samantalang ang equity ay nakakaepekto sa struktura ng pagmamayari at kontrol sa kumpanya, which means ang leverage ay ibig sabihin nito sa kumpanya. Valuation, ito ay para sa pagpapalawak at pagtaas ng kita, ngunit hindi ito maayos na mapamahalaan ay maaring magdulot ng financial distress. Tapos, an ownership structure at control sa equity ay nag-iimpluwensya sa kontrol ng kumpanya. Ang mga shareholders na may malaking bahagi ng equity at may maraming kapangyarihan sa paggawa ng desisyon. That's all for the similarities of debt and equity capital. Thank you.
Good day, everyone. I'm Angelo Lonzaga, and today we're going to talk about sources of short-term financing. Firstly, let's talk about accruals. Accruals are revenues earned or expenses of money that have been earned or spent but not yet paid. So basically, for example, if we talk about accruals, in this scenario, tax solution would record 100,000 as revenue in March, even though they haven't received the cash yet, but it's because they have earned the revenue by completing the work. On the balance sheet, this 100,000 would be pre-recorded as account receivables, which an asset represents the money owed to the company. Secondly, let's talk about intercorporate deposit. It is a short-term unsecured loan between businesses, typically up for 6 months, where one business borrows funds at a specific interest rate without collateral. There is a 3-type deposits: a 3-month deposit, a call deposit, and a 6 months deposit. Usually, how this call deposit works is when a company has no specific date or time that they want their money back. Moreover, intercorporate deposit is usually unsecured because you don't offer a collateral. So when you're borrowing money from another businesses, you're paying for the flexibility of it. And usually when you're borrowing from another business funds, they usually are in a higher rate of interest. So it's much more expensive, but when you're short, it's really needed, and it can be a solution for a short-term financing. Public deposit, an unsecured borrowing method where a company raises funds directly from the public who deposits money for a set period of time for return in fixed interest. So one of the example of this example of public deposit is when, for example, you're trying to open a company and you advertise for the public for your expansion project, or like the business you want to start. And then in return they will have a 6% rate per annual for a deposit made for 3 years. So these individuals are interested in investing can deposit funds for a specific period and receive interest payments at regular intervals. At this end of the period of 3 years, the company will repay the principal amount for the individuals slash the depositors. Thirdly, let's talk about commercial banks. Commercial banks are financing institutions that provides a wider range of banking service to individuals and business and governments. Their primary role is to accept deposit from customers and lend money to those who needed it. For these examples of the commercial banks are BDO, Metrobank, Land Bank. These are the examples of commercial banks it's where you can borrow money from or funds from these banks. And usually there's an upside to this. When you try to borrow funds or loan funds on a company from these commercial banks, investor would usually have an eye on you, or will will have an approval when they wanted to invest on your company, because usually commercial banks are hard to get into. So you have a higher chance of getting an investor or getting investor of your company if you applied to commercial bank and got approved. Here are some forms of bank financing are loans or utang. This is a borrowed funds repaid over time with interest. Letter of credit, a bank guaranteed payment ensuring a seller receives payment from a buyer, often used in international trade. Letter of credit is usually when you have a customer or you have a buyer from another country, and usually processing their currency is much more harder, or it takes time. So the bank gives you money, so the bank pays the amount of of money that the foreign buyer had for them to give it to you. So over time, when the processing is done, the bank will get their money back again. And then cash credits is a short-term line of credit allowing businesses to withdraw funds up to their limit, usually secured by collateral. So cash credits, it is used when you're tight on money, and then usually you have emergency things. For example, your company or your business had unexpected bills, and then you use cash credits to draw more than the amount of balance that you have, but there's a certain limit, and it's usually secured by collateral. So they have something that you own, or an asset that you have, or inventories or whatever, that's collateral, and that they own, that you own from them. So they're gonna hold on to the collateral, which is the assets that you have, for until you get the amount of money that you borrowed.
These some forms of bank financing. Overdraft. Banks that allows account holders to withdraw more money than they have in their account, up to certain limit interest charged only on the overdraw amount, making it flexible financing option. Discounting of bills or purchase. In this form financing, a bank purchase a bill of exchange or a document showing a promise to pay before its maturity date at a discount price. For example, the bank provides the business with immediately cash, and when the bill matures, the bank collects the payment from the buyer. This is a way for business to quick access to, to cash tied up in a receivable. Deferred income is a kind of income that firm receive in advance of supplying service or goods in the future period. These payments are recorded in the balance sheet as a form of income received in advance but are not shown as revenue at the delivery of products or service. For example, the advance can be requested by firms who have monopoly power, high demand for these goods, and if the company is producing a unique item on a particular demand. Commercial paper or CPS, short term that unsecured promissory note that typically issues by companies with a good credit rating. It serves as a backup source of funding and beneficial when bank credit is limited. When compared to bank credit, is a less expensive source of short-term financing. Installment credit, which requires that the borrowed money is paid back with interest in equal installments. Suppliers offer installments credits to the company with the promise that repayment will be made in a fixed amount and the regular intervals.
Good day everyone, especially to our instructor, Sir Alvin Lentejas. My name is Strawberry Ejoc, a BSIS 2B student, and today we will be presenting our last topic, which is the sources of long-term financing. To understand it better, when we say long-term, it takes a period longer than 1 year. So in business, it applies to plans, goals, or financing. While financing is getting money to pay for things a business need, it can come from loans, investors, or other sources. Long-term financing provides money for a business to buy essential assets for over a year. So long-term financing, to understand it better, is a money a business borrow to pay for big items it needs like essential assets. So when we say essential assets, these are your ari-arian. These assets are important to things a business needs to operate and grow. Also necessary for the business to run effectively and also make a profit. So now that we already know the meaning of long-term financing, now we are going to talk about the major sources of long-term financing. So for the first one, we have equity financing. So again, when we say equity, it represents the value of the owner's share after all the debts are paid, after ang mga tanan na utang na baydan. So equity financing is when a business raises money by selling shares. Investors who buy shares become part owners of the business. No repayment is required, but profits may be shared. So in short, to understand it better, equity financing is the process of raising capital through the sale of shares. It helps fund businesses' growth without adding any debt or utang. As what you can see here in the illustration, to understand it better, companies sell shares to investors so that both the company and the investors can raise funds. So to understand better, here is an example of an equity financing. So let's use the example of SM Investments. So, SM Investments Corporation sells their shares on the Philippine Stock Exchange or BSE. They use the money from selling shares to build new malls and expand their business. So, ang Philippine Stock Exchange, sila ang nagpa-facilitate on the buying and selling of securities. So, this includes stocks and bonds. This allows investors to trade these financial instruments. So, this is how equity financing works. First, by selling shares. So, companies raise funds by selling shares, which gives investors ownerships in the company. So, example, if you buy 10 shares for 1,000 pesos each, 10 shares total to 10,000 pesos each, tapos later, i-decide na ibaligyan mo into 1,500 each, you make a profit of 5,000 pesos. So, next is ownership. So, by buying shares, gives investors ownership and voting rights in the company decisions. So, example, if you buy 1,000 shares of a company that has a total of 100,000 shares, you own 1% of the company. So, when investors buy shares, they gain ownership rights in the company. So, this often includes voting rights on important company decisions, such as electing the board of directors. Third is by profit sharing. So, companies share profits with shareholders through dividends. So, when we say dividends, these are the payments made to shareholders from a company's profit. So, example, if a company earns a profit and decides to pay a dividend of 5 pesos per share and you own 200 shares, you would receive, here's the computation below, 200 shares times 5 pesos equals to 1,000 pesos in dividends. And lastly, we have value appreciation. So if a company grows its shares price may increase, allowing shareholders to sell for a profit. So example, if you buy 1,000 shares at 10 pesos, total of 10,000 pesos each, if the share price rises to 15, you can sell your shares for 15,000 pesos, making a profit of 5,000 pesos. So, parang shares lang din siya. That's how it works. So, now we are going to talk about the types of equity financing. So, for the first one, we have public equity. So, companies raise money by selling shares to the public during an initial IPO on a stock exchange. So, for short, this is the ownership in a company through shares sold to the public. So, to understand better, IPO is a way for a company to transition from private to public ownership, providing access to a wider pool of investors. So, while stock exchange, bagan PSE example, again, siya nagpa-facilitate on buying and selling of company shares, making it easier sa mga investors nga makaparticipate sa market. So, for example, we have here PLDT. So, PLDT is a leading telecommunications and digital service provider here in the Philippines. So, PLDT is publicly listed sa PSE. It enables shareholders to invest in the company. Next is we have Ayala Corporation, one of the largest and the oldest corporations here in the Philippines. So, it also involved in various sectors such as mga real estate, banking, telecommunications, and utilities. So, also, its shares are traded on the PSE, Philippine Stock Exchange. Lastly, we have Jollibee Foods Corporation. Known for its fast food restaurants, Jollibee is a popular brand here in the Philippines and is also publicly traded on the PSE, offering shares also to investors. Second is we have private equity. So, companies raise money by selling shares to private investors such as venture capitalists or often equity firms to fund startups or smaller businesses. So, when we say venture capitalists, these are investors who gives money to new or growing companies in exchange for part of ownership, expecting the business to grow and make money. So, an example of venture capitalist is a new Filipino food delivery app, hoping it becomes successful and also profitable. So an example here in the Philippines of a private equity is Kumu, a popular Filipino live streaming app. Received investment from private equity firms like Open Space Ventures and SIG. So these investors provided funding to help Kumu grow and expand its services. Third type of equity financing are angel investors. So angel investors are wealthy people who invest in startups for part ownership and may also offer guidance. So a sample here in the Philippines is Joey Concepcion, founder of Go Negosyo. He has invested in and mentored local startups, supporting their growth for providing funding and businesses advice. So the fourth type of equity financing is the crowdfunding. So crowdfunding are companies that gather small investments from many people online, sometimes giving back ownership shares. So an example here in the Philippines is a Filipino social enterprise that raises funds through a platform like Spark Project, where many Filipino invest small amounts to support its mission and in some cases get a share in the company. The second source of long-term financing is debt financing. So this is when a company borrows money and agrees to repay it with interest, often through bank loans or bonds. So how does debt financing works? So first, by borrowing money. So a company borrows money from a bank or sells bonds to investors, promising to repay it with interest. So to understand it better is an example of debt financing here in the Philippines is when SM Investments Corporation issued bonds to raise funds for expansion. Investors bought these bonds and SM promised to repay them with interest over time. So the second one is repayment terms. So this is when a company borrows money. It agrees with the bank on how much to pay back each month or year, the loan duration, and the interest rate. So an example to understand it better is Philippine Airlines took out a loan to purchase a new aircraft. So they agreed with the bank on monthly repayments over several years, with an interest rate included in the terms of the loan. So there are two types of debt financing. First is we have loans. So loans are money that are borrowed from a bank to be repaid with interest. Loans can be secured, backed by assets, or unsecured, meaning no assets. So an example to understand it better is Jollibee Foods Corporation. They secured a loan from a bank to fund its expansion and store development. The loan was backed by assets like its existing properties. The second type are bonds. So bonds are companies or cities that issues bonds, IOUs, to raise money, promising to repay with interest. So to understand it better, IOU stands for I own you. So IOU is a written promise to repay a debt. It's an informal note saying one person owes money to another. Bonds are a formal type of IOU. So an example to understand it better is Metro Manila Development Authority or MMDA. They issued bonds to raise funds for infrastructure projects like road improvements. Investors bought these bonds and MMDA promised to repay with interest over time. So the third type of long-term financing is retained earnings. So retained earnings are profits a company keeps to grow the business or pay off debts instead of giving them as dividends to shareholders. So when we say retained, it means to keep or save, not given out or away. So this money is used to help the business grow or pay off debts. So how does the retained earnings work? So first is calculation of retained earnings. So the retained earnings formula is retained earnings equals previous retained earnings plus net income minus dividends paid. So to understand it better, when we say previous retained earnings, these are the amounts saved from profits at the end of last year. While net income, we already know that is the profit left after subtracting all the expenses from revenue. Then dividends paid are the money given to shareholders, lowering the amount the company money keeps. So, for example, imagine a small cafe in Caibog. So, let's use Binder Cafe, for example. So, let's say last year, Binder Cafe had 150,000 pesos saved as retained earnings. That is the profits at the end of the last year. So, this year, the cafe earned, let's say, 60,000 pesos, but paid 15,000 pesos in dividends to the owners. So, to find the new retained earnings, so retained earnings is equals to 150,000 pesos plus 60,000 pesos minus 15,000 pesos equals to 195,000 pesos. So by the end of the year, Binder Cafe has 195,000 pesos kept as retained earnings to grow the business or let's say pay off debts. So second is the purpose of retained earnings. So companies use retained earnings for first, we have reinvesting. So funding new projects or expanding the business. Next is paying debts, paying off loans or other obligations. The third one is financial security, which keeping money for future needs or emergencies. So the fourth type of source of long-term financing is we have leasing. So leasing allows businesses to use equipment or property without buying it. So instead of paying a big amount upfront, the business pays a fixed amount regularly or usually monthly to use the asset for a set of time. So when we say lease, it is a contract to rent something for a set time in exchange for regular payments. So to further understand what leasing is, let's give you an example. Like for example is leasing equipment. So Hemasuto Builders here in Caibog needs a crane but doesn't want to buy it. So they lease it for 12 months at 50,000 pesos per month, saving on upfront costs. Other example is let's say leasing office space. So Paymaya, a tech company needs office space but can afford to buy property. So they lease an office for 2 years at 100,000 pesos per month, conserving cash for business growth. So how does leasing works? So the first one is we have lease agreement. So a lease agreement is a contract between the owner, the lessor, and the user, the lessee, that specifies the rental period and payment amount. So to understand it better, for example, is Honda Cars here in the Philippines, which offers vehicles leasing to businesses. A company can lease a car for 3 years, paying a fixed monthly amount, allowing them to use the car without buying it. So the second one is we have two types of leases. So for the first one, we have operating lease. So when we say operating lease, this is a short-term lease where the lessee can return the asset or renew the lease at the end. So an example to this is the PBB or Philippine Business Bank. So they offer vehicle leasing. A company may lease a vehicle for 3 years and at the end of the lease, the company can either return the vehicle or extend the lease. So for the second one, we have capital lease. This one is a long-term lease that works like a loan, where the lessee can often buy the asset at the end for a set price. So for example is the BPI, Leasing Finance Corporation. So they offer financing for businesses to lease equipment like trucks or machinery. For instance, a company may lease a delivery truck for 5 years with the option to purchase it at the end of the lease for a fixed price. So for the fifth type of sources of long-term financing, we have convertible debt. So this is a loan that can be converted into shares of the company's stock instead of being paid back in cash. So when we say convertible, this means something that can be changed into a different form. So in finance, it refers to a loan or bond that can be converted into company shares instead of being repaid in cash. So this means instead of getting paid back in cash, the lender can get company shares and become a part owner. So to understand it better, let's say an example again of convertible debt is SM Investments Corporations. So the company issued convertible bonds allowing investors to lend money to SM but with the option to convert the debt into SM shares after a period of time. So this allows the company to raise funds without immediately giving up ownership. So, and investors as well have the potential to benefit from the company's growth by converting their debt into stock. As convertible debt works, to understand it better, we have first a loan agreement. So, a loan agreement is a contract where a company borrows money and agrees on the amount, interest, and when to pay it back. So, let's say an example, a local business here in Caibog, like a restaurant, takes a loan from Land Bank of the Philippines. So, they agree to borrow 50,000 pesos with an interest rate of 8% per year and a repayment term of 5 years. So, the terms are outlined in the loan agreement. Next one is we have the conversion option. So, let's the lender change the loan into a company shares later, usually when the company grows. So, let's say an example is the First Gen Corporation. So, this is a large energy company here in the Philippines. So, they offer convertible debt into investors. Instead of paying back the loan in cash, the company allows lender to convert their loan into shares of the company's stock once the company grows and the shares increase in value. So for the third type, we have conversion terms. So this is the agreement that explains how the loan can be turned into shares. So this includes how many shares the loans equals and any conditions that must be met. So let's say an example of Globe Telecom. They offer convertible bonds with terms saying that for every 10,000 pesos bond, an investor can get 100 shares of Globe after 3 years, but only if the company meets a certain goal.
Good day everyone, especially to you Sir Alvin. My name is Cabonegro from BSIS 2B and my topic is government and development loans. Long-term loans from the government or certain banks offer lower and interest rates and better terms to support farming and small business. So ini nga mga pautang nagahatag san mga ubos nga mga interest ngan mas maupay nga mga termino sa pagsuporta sa mga importante nga mga lugar sugad sa mga dalan, agrikultura ngan gutiay nga mga negosyo nabulig ini nga mga bahin san ekonomiya nga magtubo san mga barato nga paagi. Example, ang gobyerno san Pilipinas pinaagi san pag-uswag san agrikultura nagahatag san mga pautang san mga parauma basin makapalit san mga binhi nga mga kagamitan san mga ubos nga interest nga nabulig sa era mga pamauswag sa era mga production ngan kita. How governments and development loans work. First, provided by governments, institutions, loans from government, banks or agencies. Example, DBP and Land Bank of the Philippines and naghatag san pautang ngadto san cooperatives para buligan ang era mga operasyon sa pag-uma pinaagi san pagpalit san bago nga kagamitan. Second target sectors, infrastructure, building roads, bridge. So example, an LBP nagtukod sa Cavite Laguna Expressway kalax nga proyekto nga nabulig sa pagsakop san baybayon para sa mga materialis ngan construction.
So for the last source of long-term financing, we have securitization. So this is when a company combines financial assets like loans or receivables and turn them into securities or financial products. So to understand this, these are sold to investors, allowing the company to get cash upfront by selling the right to collect future payments from those assets. So for example, to understand it better is, let's say, BDO Unibank. So BDO Unibank groups home loans from its customers and turns them into securities. So these are sold to investors who get the interest payment from the loans. So BDO receives cash upfront to use for other projects. So there are 4 types on how securitization works. So first, we have pooling of assets. So when we say pooling of assets, a company combines various financial assets like home loans or credit card payments into one large pool. So for example, again, let's use BPI Capital Corporation. So BPI may pull together home loans from BPI Family Savings Bank and then turn them into securities, which are sold to investors to raise funds. Second is we have creating securities. So when we say creating securities, the company creates securities like bonds from pooled assets representing a share of future loan payments. So for example, we have PNB or Philippine National Bank. They might create securities from a pool of home loans and sell them to investors who receives a share of the future loan payments. So the third type is selling to investors. So the company sells securities to investors who will receive future loan apps. So in return, the company gets an immediate lump sum of cash. So for example is the Ayala Land. So Ayala Land may pull together property loans and create securities. These securities are then sold to investors who will receive payments from the property loans over time. So in return, Ayala Land gets a lump of cash to fund new projects. So for the last one, we have investors earn interest. So investors earn money from the interest on the loans in the pool, while the company no longer collects the payments. So example again is Metrobank. They create securities from a pool of car loans and then sells them to investors. Investors earns interest from car loan payments while Metrobank no longer collects those payments. So to sum it all up, long-term financing helps businesses get steady money for growth, makes payments easier, and keeps cash for daily needs. But it also has some downsides, like higher interest costs, the risk of losing assets, and less freedom to adjust financially. But knowing all of this helps businesses make better choices for their future. So that is all for Group 5. Thank you for listening. Bye!